Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. In this video, we're going to cover the 2 tests that you must satisfy in order to not owe any tax on the gain from the sale of your primary residence. We are also going to cover the scenario of what if surviving spouse sells the primary residence after deceased spouse has passed away. By the way, in case anyone is not clear, we're talking about the exclusion of $250,000 of gain for a single filer and $500,000 of gain for married filing joint filers. These are the amounts of gain that can be excluded on the sale of your primary residence if you meet the tests we are about to cover. Okay, so test number 1 has 2 parts. Starting right here, test number 1, part 1. During the 5-year period ending on the date you sold or exchanged your home, you owned it for 2 years or more. This is commonly referred to as the ownership test, and for married filing joint, only one spouse needs to satisfy this test. Okay, test number 1, part 2. During the same 5-year period ending on the date you sold or exchanged your home, you lived in it as your main home for 2 years or more. This is typically referred to as the use test, and for married filing joint, both spouses need to satisfy. Okay, now you might be wondering, how in the world could somebody own or use a home for 2 years and then maybe not use it for 3 years, but then sell it after 5 years? And the most common answer would be that they turned it into a rental property at some point during the 5-year period. For example, look at this fact pattern. Let's say that you are a married filing joint couple and you lived in this home for 1 year. Then you turned the home into a rental property for the next 3 years. And then you lived in the home once again in year number 5. This fact pattern right here would qualify for the exclusion of gain. They owned the home the entire time and they lived in the home for 2 years out of the previous 5. Now, test number 2 is that you haven't excluded gain on the sale or exchange of another main home during the 2-year period ending on the date of sale or exchange of your home. Let's do a quick concept check. In other words, they don't want you to get into the business of flipping homes and excluding the gain from taxation over and over. Okay, now what about surviving spouse? Well, surviving spouse gets 2 years of time after deceased spouse passes, where the home can be sold and $500,000 of gain can be excluded from income, provided that the following conditions are met. The conditions are that as of the date of death for deceased spouse, one spouse has to satisfy test 1, the ownership test. Both spouses need to satisfy test 1, the use test, and both spouses need to satisfy test 2, that they haven't done this for the 2 prior years test. Another requirement is that surviving spouse doesn't remarry before the home is sold. Now, following up on the same example, let's say that the couple lived in the home right here, then they were living somewhere else and they turned it into a rental property for 3 years, then they lived in the home for 1 more year, and then let's assume that deceased spouse passed right here between year 5 and 6. Surviving spouse would have until the last day of year 7 to sell and still be able to get the $500,000 of gain excluded from income. In addition, you may still be able to get some or all of the $250,000 or $500,000 exclusion, even if you don't satisfy the use test of test number 1 under either of the following situations. Number 1, your sale of the home was due to changes in employment, health, or unforeseen circumstances, or you or your spouse were serving overseas in the military, in the intelligence community, in the foreign service, or in the Peace Corps. So it's worth looking into these exceptions to the use test if any of those situations apply to you. Now let's do a quick concept check. Think back to the example we just went through with surviving spouse. What situation regarding the deed on the house is likely implied in what we went over? And it would be that both spouses are listed on the deed in the example we just went over, meaning that one spouse is not inheriting the property from the other spouse. If the property is passed to the next person through an inheritance, then there would be a step up in basis to the fair market value of the property, basically effectively wiping out all of the gain anyway. Thus, these nuanced rules regarding surviving spouse still getting to exclude up to the $500,000 of gain for 2 years after deceased spouse passes becomes much less relevant. By the way, in order to get everyone organized and ready to go for the 2026 tax season, my fully updated 2025 tax prep / 2026 tax planning information organizer is now ready and available for download. The tax organizer is available to all of my viewers, and it contains over 197 tax questions and related guidance to help you get all of your tax ducks in a row during the 2026 season. You can find a link to download the tax organizer in the description below this video on YouTube. In addition to that, my 2026 tax season prep and planning class has launched as of February 1st, 2026. The class will be running through April the 15th, 2026, and all class sessions have been recorded, so you can log in and watch every training video on your schedule and at your convenience. This 10-week intensive tax class will dive deep into the world of both tax preparation for 2025 and tax planning for 2026 and beyond. You can find a link to the video FAQs about the class at the link in the description below this video. And so that's going to be it for today's video. Thanks everybody for watching, and I'll see you next time.